In this section, I demonstrate basic bond valuation and later on the impact of inflation on the value of a bond. This will be done through an emulator mode finance calculator, in this case the BA2 Plus by Texas Instruments. Just a very quick overview of the theory of basic bond valuation. The current value of a bond is basically the present value of the future interest stream that emanates from the bond, and also the present value of the future value of the bond at maturity. VB is the value of the bond at time zero, that is the current price of the bond. INT is the annual bond interest in dollars, which is the interest payment, also called the coupon payment. M is the par value of the bond, which is the face value of the bond at maturity. KD is the required rate of return, or the discount rate. And N is the number of years to maturity. Essentially, there's a negative relationship between the value of a bond and the required return, or the discount rate. You see, as the discount rate increases, the value of a bond decreases. At 8%, the value of a bond is $1,134. At 12%, the value of a bond is $887. In other words, as the interest rates go up, the present value of a bond comes down. This particular example is for a 10-year bond paying a 10% coupon, which would mean 10% of $1,000, that's $100 is the value of the coupon or the periodic interest rate. The future value or the par value of the bond is 1,000, and the interest rate at these 2 points is 12% and 8%. I'm just setting up the numerical entry into the calculator and giving you a little bit of the theory behind bond valuation. You have to refer to a book for a complete exposition on the fundamentals of bond pricing. The focus here is how to calculate the price of a bond using this finance calculator. So let's see. What's the value of a 10-year 10% coupon bond if the discount rate is 10%? Now we set it up on a timeline, and this is a variable which is unknown, which is the current price of the bond. As a bond trader, you would like to know what is the price of such a bond. So after 1 year, it generates $100. 2 years generates $100, which is your interest rate. However, upon maturity, you have to add on another cash item to it, and that's $1,000, which is the face value of the bond. So the current price of the bond is the sum of the present value of these cash streams. Notice you can't just add them up because of the time value of money, which means the $100 a year from now is worth less than $100 today. By how much exactly? That's where the discount factor comes in, 1 plus RD. So 1 plus RD to the power 1. So RD is 10%, so that would be 1.1 to the power 1. And that becomes 90.91. You can do that yourselves. Actually, let's see, I can show you that. You do 100 divided by 1.1, and that's 90.9091. That's 90.91, which is exactly what you see here. You can clear this by hitting the CE button. The 10th cash flow is comprised of $100 interest and $1,000 face value, and that comes to 385.54 plus 38.55. And so in this case, the current price of the bond is $1,000. Now all of this sort of looks messy, but can be simplified using the finance calculator. And so this is how you set it up. The bond consists of a 10-year 10% annuity of $100 per year. Where do you get the 100 from? It's 10% of 1,000. When it's not specified, the face value of a bond is assumed to be 1,000. So 10% of 1,000 is $100 plus $1,000 lump sum at t equals 10. So let's enter these values. So it's a 10-year bond. So you use the time value of money keys, which on the finance calculator are the following 5. N is the number of years, IY is the interest rate per period, PV is the present value of your asset. PMT is the payment at regular intervals, and the payment is of equal amounts, and FV is the future value of your asset. So for bond pricing, in this particular case, N equals 10. So do 10 and then hit N. Notice it's important that you first enter the number and then the associated key with it, not N and 10. Okay. The interest per period in this case is 10%. So do 10 and now hit IY. The payment is 100. And the appearance of this small little triangle indicates that the value has been accepted and stored in the calculator's memory. If you do not see the triangle, that means you forgot to do something. You forgot to hit the associated button, and you need to redo it again. And the future value or the par value of the bond is $1,000. So now we have 4 out of the 5 unknowns in there, and you want to compute the value, the PV. So you hit compute and PV, not PV and compute. First compute and then PV. So compute PV, and that gives you minus 1,000. The minus is actually, not a bad thing. Minus means the cash flow is negative. That means the cash goes away from you. Think of it like that. And so it means that you have invested $1,000 in a bond, and that gives you the present value of the bond, which also is, you can see this here. In fact, this particular breakdown here gives you the component of this current value. $614 is associated with the interest stream, and $385 is the present value of the maturity value of the bond. You can go back here. I can show that to you. So that 385, that's 1,000 divided by 1.1 to the power 10, if you want to do that. If you want me to show you how to do that, so that's 1,000, and then divided by hit this parentheses here, simplify things, 1.10 to the power, which was this here, y to the power x, 10, and then close paren, and then hit the equal button. And so you get 385.54. So that was also a small little demonstration of how to use the y to the power x button. And clear the screen. And now I want to show you the impact of changing interest rates on the pricing of a bond. So in this example, we saw that the current price of a bond is $1,000 at 10%. The question is, what would happen if the expected inflation rose by 3%, causing the discount rate to increase to 13%? Once we have set the problem up, which we have in the calculator, all you have to do is change IY to 13 and hit compute PV, and you'll get $837.21. Let's do that. 13 IY, and that is all registered. Now do compute present value, compute present value, and this time you don't get 1,000. Notice this slide is different from this one. Here IY was 10 and compute PV gave us $1,000. By the way, this is also a very special and in a way a trivial case where if the discount rate that is being applied is the same as the coupon rate, which is also 10%, that's how you get $100. If the discount rate and coupon rate are the same, then the present value and the future value of a bond will always be same. In fact, you don't even have to calculate it. So if you have 10% discount rate and the coupon rate is 10%, which you can see because 10% of 1,000 is 100. It's a special case when the present value will be exactly equal to the future value. This is not happening in this example. The coupon rate is 10%, but the discount rate has gone up to 13%. And so the present value is $837 with a negative sign. The negative sign simply indicates that you have to invest in it. So basically, when the discount rate rises above the coupon rate, which is 10%, the bond's value falls below par. And so that is also called a discount bond. Why? Because the coupon rate is less than RD. Think of it like this. Can be usually hard to sort of conceptualize, but actually it's very simple. Is if there's a certain bond that is associated with 10% coupon, and then the market rate increases to 13%, the price of the existing bonds will plummet. Why? Because the new bonds, they will offer a coupon of 13%, let's say. So the existing bonds, they will witness a severe decline in their value. Let's look at the opposite case. What would happen if inflation fell and the discount rate declined to 7%? Well, all you have to do is change this IY term here. How do you do that? 7%. Let's clear the screen. 7% IY and compute PV, and notice the $1,000 bond is now worth $1,210.71 basically. So now the coupon rate, which you can extract from this, notice this is a dollar amount, it's not a percentage. So the coupon rate is 10%, is higher than the market discount rate of 7%. Basically, you've locked into a bond which is offering you a higher periodic rate of return than what's there in the market. Naturally, it becomes a premium bond. It does not necessarily mean that it's a good deal because you're paying up for it. So to be able to get an interest stream higher than what the current market rate is, you're basically paying up for it. So that's was sort of a tangent topic there. Is don't think that a premium bond is like a good deal or you're getting a special deal on it. You're paying for it. But nonetheless, it's premium because it trades above its par value, which is $1,000 in this case. So that was a demonstration of the calculation of bond prices using a finance calculator and the impact of inflation on bond pricing. This is Pank Agarwal, PhD Finance, giving you a tutorial on this topic.